We like to think that a stock's value is a hard number, something that's discovered with, impartial math. But what if it's more like a range? What if inside the accepted rules there's a hidden flexibility that can change a company's value by billions, or, get this, even trillions of dollars? Well, that's what we're calling the Wall Street gap. And make no mistake, the stakes here are incredibly high. When a Wall Street analyst puts out a buy, a hold, or a sell rating, the market listens. We are talking about billions of dollars moving on their say-so. Their opinion literally shapes the financial reality for companies and, well, for all of us.
So, today, we're going to pull back the curtain on this whole thing. We'll kick off with the basic conflict an analyst faces, look at the big attempt to fix it, and then we're going to dig into the math itself to find this Wall Street gap. And finally, we'll ask if there's maybe a better way forward.
Okay, let's dive right into the heart of the matter. It's this idea, this myth of pure objectivity. See, we all count on these sell-side analysts to give us unbiased advice, but the truth is they're dealing with a massive conflict that's just baked right into their job description. Here's the trap. An analyst, on one hand, has a duty to us, the public, to give their honest, unvarnished opinion on a stock. But they work for a firm that also has a huge investment banking division, right? The part that makes massive profits from its corporate clients. And what do you know? The analyst bonus is tied to the firm's overall profits. So the temptation to publish a, let's say, glowing report about a big banking client, it's huge.
Now, it's really, really important to be clear about what kind of problem we're talking about here. Is this just, unavoidable human bias, or is it something more systemic? Because the answer to that question changes whether you can even try to regulate it.
And this is a really key distinction. Okay, so selection bias, that's just human nature, right? We all tend to favor information that confirms what we already think. You can't really write a law against that. But a conflict of interest, that's a whole different animal. That's a structural problem. That's when the system itself is set up to reward you for serving two different masters with totally opposite goals. In this case, the public and the firm's clients.
And the research is pretty clear on this. Let me be blunt. When an analyst's bank is advising on a big merger, and then that same analyst suddenly upgrades the buyer's stock right before the deal, that is not a coincidence. The source material says this is a textbook conflict of interest. It's a flaw in the system. All right, so you might be thinking, surely someone has tried to fix this. And you'd be right. After the dot-com bubble burst back in 2000, regulators stepped in with what was supposed to be the big solution. This should have been the end of the story, right?
So in 2003, we got the global settlement. It was a massive deal. The top 10 investment firms all agreed to build this so-called firewall between their research analysts and their investment bankers. No more bankers leaning over the cubicle wall whispering to an analyst to sweeten a report for a client. Problem solved. Or so they thought. Well, not exactly. The truth is, the results were kind of mixed. The good news? Yeah, those super obvious optimistic reports did decline. That's a win. But an unintended thing happened. Analysts got nervous. They started putting out vaguer, less helpful reports. Moving from those detailed 5-tier rating systems to a simple buy, hold, or sell. And here's the kicker. A loophole was still there. The pressure hadn't vanished. The bias just got smarter. So, if you're an analyst and you can't just outright lie anymore, how do you nudge a price target higher? Well, the answer is hiding in plain sight. It's baked right into the standard models everyone uses to value a company.
So first up, we've got the discounted cash flow model, the DCF. This thing is the bedrock of valuation. The idea is simple. You project how much cash a company will make in the future, then you figure out what that's worth today. But look at that last line, heavily subject to assumptions. And that right there is everything.
And the second main tool is comparable company analysis, or COMPs. Think of this as a reality check. You just look at what similar companies are worth in the market and apply those same metrics to the one you're valuing. Seems pretty straightforward, right? But the entire game hinges on one little thing: who you decide is a similar company. And this is the loophole. This is brilliant. Look at this together. To do a DCF, you need a risk-free rate. Okay, should you use the 10-year government bond or the 30-year? Both are perfectly defensible. What about the market return? Do you use the long-term annual average or the more recent quarterly number? Again, both are justifiable. An analyst can literally pick and choose from a menu of perfectly acceptable inputs to engineer the number they want, all without breaking a single rule. So what's the actual impact of just toggling these little switches? The study found that inside the DCF model alone, an analyst can create a 26% swing in a company's final valuation. Let that sink in. For a $100 billion company, that's $26 billion of value that can appear or disappear based on choices that are all technically correct. And it doesn't stop there. By just carefully choosing which companies to include in the peer group for a comps analysis, an analyst can swing the valuation by another 20%. All of a sudden, the two most trusted tools for finding objective value, well, they start to look more like toolkits for building a desired number.
So let's zoom out for a second. What happens when you take this wiggle room and you apply it to the entire stock market? Well, the numbers get absolutely staggering. According to the research, if you average out the flexibility from both of these methods, you land on a combined discrepancy of 23.2%. And I want to be clear, this isn't an error margin. The paper argues this is the analyst's built-in, justifiable leeway for just about any stock they cover. Okay, so what happens when you take that 23.2% wiggle room and apply it to the S&P 500? You get this. $11.1 trillion. That is the size of the Wall Street gap. It is the total amount of market value that can be justifiably manipulated, all while staying inside the lines.
So, if the big regulatory fix from 2003 didn't really solve the problem, and the valuation models themselves have this much flex in them, what on earth is the answer?
Now, this is maybe the most interesting part of the conclusion. The author suggests that just piling on more rules and regulations might not be the answer. In fact, it could actually backfire. You could regulate the industry so heavily that you stamp out all the genuine insight and value that good analysts really do bring to the market.
So the solution being proposed isn't another law. It's a culture shift. Imagine an industry where an analyst's reputation for being accurate over the long haul is their most valuable asset, where their bonus is tied to being right, not just to how much banking business they bring in. The argument here is that rebuilding public trust might just be way more profitable in the long run than chasing those short-term wins.
And that leaves us with the the trillion-dollar question. We've seen the conflict of interest. We've seen the massive gap hiding in the math. So if more rules have reached their limit, is it actually possible for an industry built on these kinds of incentives to change its own culture and rebuild our trust from the inside out? That's the real challenge.